Welcome to Triple Net Investment Grade Property Introduction. My name's Gary and I'll be your presenter for this presentation. So first off, the definition of a triple net lease is basically where the tenant pays all the expenses related to the property, which mainly includes the property taxes, the insurance, and also all expenses related to the building, including the common area maintenance. So in this case, a landlord or owner really doesn't have any expenses. So why buy a triple net property? Well, there's a few reasons. First is the double-digit cash-on-cash return. Second is a guaranteed monthly cash lease payment from the tenant, and in this case one that has a strong S&P credit rating. There's tax benefits including depreciation, interest, and other types of property expenses. Minimal management activities. In this case, since it's a triple net, the tenant is paying for the cost of all the maintenance, so the landlord doesn't have any of those types of maintenance activities. Also, appreciation from a cap rate compression, and we'll go into that later in the presentation. And then finally, the tax postponement from a 1031 exchange, where a person can sell a property and buy another property and defer paying the taxes on the profits. So first, let's look into the double-digit leveraged cash-on-cash return. So the one way that we're able to make a high double-digit return is because of the leveraging. If we had paid all cash for it, we would be able to only receive what we'll call the cap rate, and we'll discuss that a little later. But by using a leveraged investment, we're able to receive a much higher double-digit return. So this is a real-life example in which a Dollar General store was purchased. And this was purchased in June of 2014. And Dollar General is a triple B minus rating, which makes them a investment grade or a national credit tenant. So banks like to loan against these types of tenants because they're very strong and they know they'll get their money back. And this was a triple net lease, so once again, with the tenant paying the expenses and the landlord pretty much having relatively little maintenance involvement. So this lease was written for 15 years. There was 14 years and 5 months left on it when it was purchased. And it was purchased for $1,378,000. Closing costs about $16,440. And an annual rent of $92,877. So now let's look at how we are able to get that double-digit cash return. First off, our annual income at $92,877, and we're going to look at it for 3 months. So once again, it was purchased in June. So for June, July, and August, this is how the expenses and the income are calculated and used to produce this return on investment in the double digits. So first off, our expenses. So the interest expense for these 3 months was $7,280. The closing costs, and this is an amortized closing cost since it was a 5-year note, and for 3 months we amortized the closing cost was $822. So our total expenses was $8,102. And that left us with a net profit of $15,118 for a 3-month period. So when you annualize this $15,000, we find that when multiplied by 4 and divided by the cash that it took to buy the property, which included the down payment plus the closing costs, which were $410,000, that the return on our investment is 14.4 14.73%. So basically, if we look at note 2 at the bottom, we multiply that 15,818 by 4, divide that by the money it took us to get into the property, and we find out we're annualized at a 14.73%. So another reason for buying these properties is that the monthly cash lease payments are pretty much guaranteed because you have a very strong tenant, so they're going to continue to pay you. And Dollar General in this case is a very strong tenant, and it's easy to get loans from banks because they have such a high credit rating. And of course, Dollar General wants to continue to make their payments because if they didn't, they would be violating a contractually binding obligation, and they're in business to run their stores, and they pay their rent, and they continue to run their stores and make their money from the products they sell. So additionally, the Dollar General would not miss a payment because that would likely reduce their credit rating, and that then would make it very difficult for them to do business. So pretty much a sure thing here with the payment schedules. So now we'll move on to the tax benefits. Depreciation first is a large benefit, and there's ways to calculate depreciation. There's a relatively simple straight line method, and there's more complicated methods that use an accelerated depreciation method as well as a cost segregation methodology where more depreciation can be taken in the first few years of the ownership of the property and then less depreciation in the last few years. So also interest expense is tax deductible, so any interest expenses paid on the mortgage will be tax deductible. And we have closing costs as being tax deductible, and once again those are based on the IRS guidelines. So in some cases a expense such as an appraisal might be depreciated in that year, where other expenses such as points on a note might have to be amortized over the length of the term. So you have to check the tax rules at the time to see how to expense those closing cost items. And finally, we have travel expenses. So just go check out your property to see how it's doing and maybe talk to the manager of the store, and the surrounding areas is also tax deductible for your airline tickets and all the other expenses that are involved. Finally, the minimal management activities. We see that since the tenant is paying for the taxes, insurance, and maintenance, that there's very little that the landlord has to pay for or be involved with. However, in some states, such as Florida, the owner will be required to pay a local or a state tax bill and then be reimbursed by the tenant. So that is a little bit of an activity, but not too difficult. And then usually in other states, the landlord will simply just see the check deposited on the first day of the month, and then they'll have, in some cases, an automatic payment for their mortgage, and what's left over will be their cash flow. So it could be, the management activities could be insignificant, and even if you do have some, it would be very minimal. So now let's look at the appreciation from cap rate compression. So there's a couple of formulas here. First, the cap rate calculation is used when the annual lease payment divided by the purchase price, and also the way a property is valued can be expressed as the annual lease payment divided by the cap rate. So here's an example. say the market cap rate moves from 6.5 to 6.25, and we'll assume a 97,500 annual income. So in this case, a property could be purchased at a 6.5 cap rate, where that would be purchased for $1,500,000, which is simply the annual income divided by the current cap rate of 6.25. Then if the property appreciates and the cap rates move down to say 6.25, we see the same annual income now divided by a 0.0625 cap instead of the 0.065, and our new value becomes $1,560,000, or an increase of $60,000 due to this cap rate compression. At the end, when it's time to sell the property, a person might want to exercise or use the Section 1031 exchange, where they'll sell the property and then buy another property, and that way be able to postpone their current tax obligation by using this IRS 1031 section exchange. So in order to do so, the few rules have to be met. First, the replacement property needs to cost more than the property that was sold. A qualified intermediary needs to be in place, and these are people that basically act like an escrow, and they hold your money from the sale and then distribute it when the purchase is done, so that the owner of the properties doesn't really touch the money, and that way the IRS allows you to postpone the profits by using these qualified intermediaries. And finally, the property that's being sold or replaced has to be held for at least a year. So now we're into the conclusion, and we see that you can earn a safe return of over 14% when you use leverage by getting a loan from a bank. And as long as you have a strong credit tenant, it's not that hard to get a loan from a bank for those types of leases. And that it would be also good to have a lease that's at least 13 years long, because shorter term leases have a low risk that at the end of the base period that the tenant may not renew. But topics that we'll discuss in the future on triple net leases will include tax calculations, and we'll show the difference between accelerated and cost segregation depreciation versus straight line, and how much more depreciation could be taken in the first few years of ownership of the property. We'll also show a real-life example of a cap rate compression and how one person was able to make a substantial amount of money based on the cap rate compression, which actually exceeded the return that they had on just the income. So that's quite exciting. Also, the tax payment deferment with the Section 1031. So we'll have an example of that as well in future videos. So if you'd like to receive more information on triple net properties, then please subscribe to the email list at www.nnnpropertiesinvestment.com. Thank you for watching this video.